All right, let's go ahead and get started here. I hope everybody is having a great day and a great week. My name is Saxon Bauman. I'm the VP of Investor Relations here at Florida Funders. Today, we have an extremely exciting webinar. We have our partner, Adventum. We have both Chris and we have Will, who are going to really talk about what we look for and what things companies should really be focusing on when looking at getting funding. I'm going to let these guys run it. I'm going to chime in every now and then we'll do questions throughout the presentation and at the end. So if you have any questions, please don't be shy. Put them in the Q&A function, put them in the chat function. I can ask the guys. And so we'll do that at the end or throughout, whatever works better for everybody on the call here today. And then we'll record this and we'll send it out after the fact, so everybody will have the recording. No need to take notes if you don't want to. So without further ado, I'm going to turn it over to the Adventum boys, both Chris and Will. The floor is yours.
We're excited to be here. Again, my name is Will Sprague. We Adventum Management and Consulting Group. We work with emerging companies and startups on the financial side, typically kind of coming in to, as Saxon said, kind of help these companies get ready to go to market and raise money. And I kind of head up the CFO practice. So I've been a CFO in small companies and medium-sized companies my entire career. Been working with Adventum for the last 4 or 5 years in this space. I'll let Chris introduce himself before we get started.
Thanks, Will. Chris Smeegi. I partner with Will at Adventum. I lead our practice on the management consulting side, get directly involved assisting our clients across the board for helping them prepare for fundraising, working through the business model, modeling the business, getting together materials and the marketing side to support raises, and then just kind of generally help solve problems for growth as well as optimizing the business model along the way. My background is more on the operator side in technology, enterprise SaaS companies, as well as big data more generally. I've supported big data projects across a number of different industries, and then most recently worked with Lumen Analytics here in Tampa for a few years on the strategy side and business development side.
Cool. All right, so let's dive right in. So let's start, kind of thinking about this subject matter. Let's kind of start at the basics from the kind of the roles and definitions of people that are a part of a finance operation within a company. So what everyone probably here is really familiar with is kind of your typical CPA, which which kind of comes from all of us that are CPAs. I'm a CPA. Chris, fortunately, is not. He's got the benefit of not being an accountant, but we can kind of talk about why he's really important to what we do. But all of us are going to have either typically a tax or an audit background, and so your typical CPA, is doing tax work, or they're auditors, an independent auditor from a background perspective, and then over time we turn into CFOs and controllers and finance teams of organizations eventually. But our background's either tax or audit. So most companies and individuals will have a CPA that they're working with from a tax perspective. That's not what we work on, or from an audit or assurance perspective. Most of the companies we work with are probably getting prepared to go through their first audit. So we'll be part of the team that'll kind of help them get started there. So that's where you're kind of thinking about a typical CPA. Then you kind of moving down to, basic accounting and bookkeeping can be done, whether it's kind of just basic, a degreed accountant or controller, accounting managers. Some of the companies we work with have these individuals as part of their team, or they use our team, which in our organization, we have both CFO, controller, accounting manager, kind of bookkeeping level, but we kind of augment those roles if they do not have them internally themselves. Then this is kind of more where Chris kind of has really stepped up and made us a really great organization from a financial analyst and a strategy perspective. Most organizations we work with do not have people specifically assigned to financial analysts. Strategies done internally. with either the founder or kind of the upper level management team. But where we were able to really bring a lot to the table. And that's where Chris has just been incredible, because from a CFO perspective, a lot of times we're doing a lot of this kind of financial analyst modeling, go-to-market strategy, all this kind of stuff, working with the management team. But, we're not really trained in this stuff like a guy like Chris is, or have the experience. So we do a pretty good job based upon our experience to help there from a CFO, but having Chris involved in that role has been huge. So those are kind of, I would tell you, over time, as you mature as an organization and get bigger, you start hiring those internally. So, if you're looking at a big company like a Tech Data or or Outback, they're going to have financial analysts that they have hired within their organization that's going to work on modeling, budgeting, all those type of things, as well as C-level executives that can kind of handle strategy. And then lastly, CFO, which is kind of the typical role that I'm familiar with, where we kind of lead the financial charge, help set the table from a management perspective on the finance side, decision making, and kind of help lead that side of the organization.
Sorry, well, just
Yeah.
to jump in here. So one thing that we see, at Florida Funders and at early stage venture firms, and we're talking about, companies doing, call it $100,000 to $1 million in annual revenue. There always isn't a CFO. Sometimes the CEO also acts as a CFO. But one thing that we see is after the investment is made, that pre-Series A, Series A type investments, one of the first roles that is filled is that CFO role.
I think you're 100% right. I mean, typically, and that's why we really are, what we do. I mean, this isn't really to be a pitch for Adventum, but what we do is really augment that role for an economical price, because that's an expensive role and typically would only be added full-time post-funding. And a lot of companies we work with, I think that we've established a great relationship with the investors as they come in, and get prepared that we kind of stay on for an indefinite period of time until, typically they'll outgrow us, hopefully at some point, and get big and need full, big, kind of robust finance teams. But you're right, Sax. I mean, most of the companies do not have this role in here, but it's an important role as we dig into kind of more of the details here, to really kind of setting yourself up for success, to go after capital, as well as, probably more importantly, operational success, right? Like it's as important to have a good company as it is important to raise capital. So I think you're kind of killing two birds with one stone, as well as doing it in an economical way without hiring a full-time CFO. So I promise that's it with the kind of pitches for our services and what we do. So let's kind of dive into what, groups like Saxum at Florida Funders and others that we work with are really looking for in their investments in companies that they're going to work with. And we'll dive into each one of these categories, but here's kind of just the broad brush strokes, from sound financials, model, large growth, growing TAM, go market strategy. You can read this, but let's dive into each one individually. So when we talk about sound financials, I told Saxon that he's going to have to kind of make sure I don't drone on about like financial statements here, but let me just kind of keep it at a really high level. The basics kind of need to be handled, balance sheet, income statement, statement of cash flows. What I will say is, just so you, from an understanding standpoint, balance sheet is a point in time. So a point in time document, meaning at any day you can run a balance sheet for, one day, yesterday, last week, last month, last year is one point in time. Income statement, same thing. You can run it for different periods, but it's for a delta between two periods. So it's run for an annual, for a year's time. So that would be 365 days or a month or a week. You could run it for a day, but unless you're Google or Apple, you don't have a lot of business that you can really kind of look at on a daily basis.
And
And then,
Will, that's also referred to as a P&L, correct?
yeah, that's right. They're synonymous, P&L, profit and loss. And I would say if we want to kind of talk about a really important thing to maybe think about when you're looking at an income statement is trying to define gross margin. So that's something that will come up repeatedly when you're talking to investors is, what are your margins, and trying to define those. And, without diving into the, details of every business, really, we're just talking about the costs that are directly attributable to revenue, meaning if you did not have these costs, imputed, you would not be able to deliver your revenue. And that's going to be materials, people or materials to deliver your revenue stream. And so if you're talking about a software company, typically they're running at really high gross margins, which is why, technology space is really exciting for investors, because gross margins can be upwards of 70, 80, at scale at 90% gross margin. And so that's important to kind of understand as you kind of dive into your financials, that you really pull that out. And then statement of cash flows, the one thing I'll say here is, it defines the, how cash is spent and acquired in an organization. And it's really broken into three categories: investing, financing, and operations. And so it just breaks how the business is working into those three categories. So without kind of boring everyone, that's kind of the basic financials. Most business systems, whether it's QuickBooks or Xero or NetSuite or Intact or any of those, are going to be able to, as long as you're doing the work to input the information correctly, they're going to be able to spit out those financial statements without you having to have an accounting degree. So,
and just so that everybody is aware, I mean, these are not extremely hard things to either do yourself and or to get somebody like Adventum to do for you. And I will tell you, when Florida Funders and any investment firm looks at a company, if there are not what we consider sound financials, there is immediately a red flag put in place. And once again, these are not extremely hard things that can be done fairly easily, either outsourced or insourced. So I would really, really pay attention to making sure that, I love the word clean, I love the word reconciled. Those are things that we want to see. And then there needs to be an understanding of these financials. It's great to be able to show a balance sheet and a P&L, but you need to talk your way through it. You need to be able to tell the story of why you got to where you're at now, or maybe you're in a bad position. Why are you in this position? The financial should be a mechanism to be able to tell the story of your business.
Could have said it better myself. I mean, I think you're 100% right. This revenue understanding is kind of our second bullet point here. We come in a lot of times, and to your point, Saxon, like, what is revenue? I have one entrepreneur that I've recently worked with. It's like, hey, I collected, $500,000 in the last month. Look, if I extrapolate that out, like, that's a $6 million business. But when you look at what revenue is and matching that to the periods that you have to deliver the services, that's kind of, a nuance that you kind of have to get past when you're thinking about revenue. And it's not just money collected. It's, if I sign a contract for 3 years and I collect $1 million up front, it's not $1 million in revenue in year one. It's going to be, roughly, 333,000 in year 1, 2, and 3, respectively, just kind of making a simple example there. So understanding that, I would tell you the complexities for us and what we're dealing with a lot, especially around technology, have to do with that revenue recognition policy, how we're recognizing revenue over the months and years, and deferred revenue and those calculations. Most companies don't have a lot more complexity beyond that, but I mean, there are some, but it's really, to Saxon, your point, you've really got to kind of understand that. And that's really important, because if you don't, and investors ask you those questions, you just want to make sure you have those answers and feel good about it. And just quickly to kind of go through these other kind of categories, I would say clean categorization is really important because, what you're trying to do is convey you're trying to paint a story or tell a story about your company. And you want to have the ability to really kind of show, like, we're running a comparable, like, income statement or P&L from like month one, January through December of this year, and we can progressively show we're making revenue, and then we can progressively show how we're spending the expenses, and they're not kind of moved all over the place. Like one month we just, we want to put, this individual down here in this line item, and okay, the next month we're going to put them up in this, and you're just not able to really kind of cleanly track what the business is doing. Here from a categorization standpoint, and Chris will probably laugh at this, it's probably more important to be consistent than it is to be exacting and right here from a comparability standpoint. So I think that's important. And then the last piece here is kind of fully reconciled internally, whether it's to bank statements and to any schedules you have that you've been tracking, and then to external systems. We do have some companies that we work with that have their own proprietary billing systems and how they are collecting revenue, and then how is that information getting into your P&L and reconciled and balanced out and all that kind of good stuff. So a lot to kind of absorb here. I know we could kind of dive into any one of these areas and probably do a small seminar or webinar on any of these, but certainly love to, if there's questions along the way or later today, we can kind of go into specific scenarios.
On that front, I would just add that the overarching kind of purpose of the financials and the consistency in having those be clean is that, especially at this stage of a business, the investors are really looking at traction and using numbers like revenue and other metrics that we'll talk about to identify traction and the trajectory of that. And so things like how clean that is and the categorization and keeping that consistent over time helps with communicating that confidence in the pattern and the velocity of traction that you've had to date, and being able to convey that is a true measure of how the business is maturing, before you have some other more metrics that go with more mature companies like EBITDA and different other measures along the way. This helps with telling that story in a confident way to investors overall. And that's why all of this kind of comes together to be important, especially at the early stage when you're having those early conversations.
Question about it. Okay, so so kind of going and dovetailing from the financials into modeling and the plan, right? So the first thing or second question or third question that comes up when you're talking to investors is, what's the plan look like? What can we expect to make? What is this investment going to do for us? And so that's where we talk about putting together a model. We put realistic, model here at the top here, just because I know we can, the one thing I can say about modeling before I go into the slide here is the one fact I know is that the model's wrong. Like, it's not going to be exact, right? Like, that's the one fact that is known, is that it's not going to be right. But what's important is to be able to substantiate, your assumptions, make sure that they make sense. They're real, again, using the word realistic based upon the circumstances and scope and scale of the business that you're building. So here's kind of, some of the kind of broader buckets I think are important. And I'll let Chris kind of dive into some of this, but I'll start with the kind of 3 versus 5 year model. I think, from my perspective, the visibility when you're talking to investors is very low, typically beyond a 3-year period. So I'm kind of a fan of keeping these models in a shorter period as we just distribute them and talk to investors. But certainly the whole modeling process, you can build it. You can build a 5 or 10 year model. It's really not that much different than if you built the fundamentals correctly. You can kind of expand it out. But to go talk to an investor that's trying to look for a return in the next 3 or 4 years, and you're talking about what your revenue is going to be in year 5, 6, 7, 8, and 10, while sounds good and will look really nice to kind of have that up and right, number, it's not really probably super relevant. But anything you want to add here, Chris, from a 3 versus 5 year model perspective? And you can dive into these other categories too, if you'd like.
No, I'd say in the early stages, I think completely agree, right? I think the confidence level, every piece of information when you start is an assumption. And so as you go through and really from a modeling perspective, when you're going out and raising capital, I'm sure Saxon can attest to this, is pretty much, everybody's model and graphs go up and to the right. And so it does come down to, when we talk about things like bottoms up and unit economics and the other KPIs, it's more than just retreating to the safety of hard numbers. It's about the process that goes into thinking through what those numbers could be and what the sensitivity ranges of what those might look like given my targets, what I'm trying to achieve, what I think my business model is going to be like. And then I really like how Reid Hoffman thinks about this in terms of the collection of assumptions that I have on a daily basis as a founder, as a team, in thinking through as I engage with customers, as I have those conversations, as I maybe close deals or not, I'm tracking my confidence, my relative confidence in those assumptions. And so, and that helps me think through, where do I sit as a business and what do I need to change? What do I need to tweak? And so when you get in front of investors and start having those conversations, it's really thinking through about, okay, when an investor asks you about what do you think the business is going to look like, it's being able to talk through what your assumptions are and why do you hold those assumptions, what conversations you've had that support those assumptions initially, with the full understanding that that's going to evolve over time. And so the reason why we build models and help our entrepreneurs build models that are, that shorter period of time, bottoms up, highlight some of these unit economics and the other KPIs that go into unit economics, is because of the value that we get from uncovering our thinking around how do we build this business and why we built it in this way, given the information that we have today. So to go into more of those, full financials just mean that we're going to focus on trying to build a 3-statement model. That's the income statement / P&L, cash flow statement, and then balance sheet to show the full picture of the business. And then we're going to identify some of those other key components. So cash burn is huge in terms of, especially at a venture round or a seed round, a lot of it comes down to how much money do I need over the next 12 to 18 months. And then that's typically where I'm going to start pegging, raise at. And so it's important to show how do I think, cash burn is going to look like and not being too capital intensive. And then unit economics, that comes down to, in lieu of other measures of profitability in an early stage, it's what does the direct cost look like and the direct revenue or benefit from a customer look like on a marginal basis, so that I can extrapolate out and help the investor and help management think about, over time, if I scale this and I pour fuel on this fire, does it hold up or does it break? And unpacking that. And so the components of the unit economics really are the CAC, the customer acquisition cost, the lifetime value of the customer, or you can think of other acronyms, are customer lifetime value, CLV. Thinking through those and mapping those out help you understand where the business model might break, and are you onto something that's going to hold up, and really are you delivering enough value to your customer to be compelling to go out there and raise capital from investors.
I think this is where Chris is incredible, our team, at going through this and really thinking this through. I think, one thing I will add around the full financials, what a really good practice here is to kind of build, you may have the sub, tabs and all the things that you do to kind of build from a bottoms up, but when you kind of get back to the outputs, to have a consistent output that's categorized the same way your financials are categorized is from a CPA perspective and a CFO perspective, is ideal, so we can kind of really understand and track along the way and build budgets and all those things within our accounting system. So I think that's really helpful. I think as you're building these KPIs and you're thinking about them, not every KPI is relevant, for every company. I think, I have a couple other ones that I've kind of mentally kind of have here, whether it's revenue per user, you have average contract values. You may not be dealing in contracts, but you can think of really good KPIs and metrics that you can build into the model that really don't take a lot of work to do once you've done it. And I think when you start sharing your model with investors, they'll be pretty impressed that you've thought these things through and you're tracking them, whether it's revenue per employee. I mean, like those are some things that really are looked at by investors, and they're going to kind of do these things themselves. And if you've already done them for them, I think it can be impressive. And so I think just to kind of wrap this up, I think the best thing here is to kind of think about, these are kind of some best practices around building your model. Ultimately, to Chris's point, it needs to support the capital needs at the end of the day. Like that's the most, maybe not the most important thing, but probably on the top 3 things that if you're building your model, it's got to kind of support what you're asking for from a capital raise perspective. And then, buzzword of cash burn, entrepreneurs, you got to know kind of like on a monthly, quarterly, annual basis, like what's your cash burn now and what will it be? So anything you want to jump in here, Saxon?
Yeah, I was going to let you guys, this is where it's at. I mean, this is the biggest part of what investors are looking for. I know that you guys are going to get into something in a bit later, total addressable market, and we'll leave that for later in the presentation. But we are all about looking at unit economics. Chris, you hit the nail on the head. Sometimes with early stage companies, it's tough to tell, what's going to happen in 3-5 years. And it's great to have projections, and going back to being able to tell the story, you want to be able to tell the story of how you're going to get there. But really what we want to see is unit economics. What's the margins look like, right? What does this thing look like at scale? Because when it's early on, it's nearly impossible to tell. But if you understand these pieces of unit economics, you can sort of see what the scaling is going to look like and where this company is going to end up. The other thing that I this is one of the most important things that I see from an operational side of the business and from a fundraising side of the business is KPIs. What are your key performance indicators look like? And benchmark those, right? Every quarter, go back to those. How are you looking? What do you look like from last year when you said this is where you were going to be? One thing that we see is a lot of companies will come back to us looking for pro rata investments, right? So this is investment after the initial investment that we made. So what we will do is we'll say, all right, let's look back at your KPIs. When you took on this investment from Florida Funders, what did this look like? What were you saying you were going to be able to achieve over an X period of time? And what does that look like? And so then a year later, we have that baseline. We can go back and say, hey, you guys said that you were going to be X with your CAC, Y with your LTV, and your traction around other KPIs around sales and revenue. This is where they should be, right? And so there's always that piece. So you always, as a company, as an entrepreneur, want to be tracking KPIs, and you want to hold people accountable in terms of your operation. You want to hold your managers accountable for these KPIs. That's the only way you're going to grow as a business or not. And so I cannot be, this is one of the biggest things that we look for is this slide right here, and then total addressable market, which I know the guys are going to get into.
Yeah. I think that's perfect, Saxon. I think one thing I will add to the entrepreneurs and business leaders that we have on here, a fine balance, which is why we put realistic in here, right? If you get investment, and you have your model and your projections and all that, Saxon and his team are going to kind of be holding you guys accountable to what's in these models and in these projections, because that's why they invested in this. So it certainly needs to be exciting enough to gather investment, but not so exciting that you miss by 200%, right? And so you got to find that balance, find that kind of exciting but realistic, achievable. It's kind of like the aggressive, achievable kind of concept of how to build it and find that balance. So That's all I had there, Saxon. I know you guys have the decks from when they first got in front of you, and you can certainly bring them right back out, right?
Absolutely. And once again, going back to the storytelling, if you can tell a good story, maybe your business isn't doing as well as the KPIs that you put in place, and your 3 to 5 year is way off. Why? What's going on? If there's a good story, you can usually skirt around it. If there's not a good story, that's when it becomes, maybe this isn't as great of a business as we initially thought when we put our first investment in. So I would really pay attention to these things and make sure that you're tracking the right things as well. I always use the word traction with early stage businesses. If you're a company that is about partnerships and you sell through channels, maybe your early traction and your early KPI isn't revenue, but it's partnerships and pilots. Whatever it is, it just needs to be defined.
No question about it. This is great stuff. I mean, we could do another webinar just on some of the details of modeling, for sure, and projections. But we'll move on for now. So again, Saxon brought it up. Investors are looking for large and growing TAM, and so this is an area where, from our perspective, my team, adding Chris to the mix is kind of really bolstered our capabilities to kind of help entrepreneurs and groups and management teams kind of look at this. But when you're thinking about TAM, these are kind of the areas and kind of the focuses. I mean, I'll let Chris jump in here, but this is something we see in every deck that every investor cares about, and they want to understand it, and they want to know that you've thought of it and how you're thinking about it.
Yeah, TAM can be, overall, it's a huge priority. There are different perspectives on, is it all about a huge TAM, or, the spectrum of huge TAM versus being focused and specific. Overall, regardless, I think the common denominator is larger the TAM on average is really going to be more compelling to investors, but then still communicating in your story and your vision for the company that we're going to start in this more niche area and solve a full problem and then scale out. But the broader vision is this larger potential. Part of the reason why when we talk about bottoms up, that's versus a Forrester or a Gartner kind of report that is a more of a top-down look at what a broader marketplace could be based on industry codes or something like that. The reason why we emphasize the bottoms up is because, generally speaking, that's what a lot of venture firms are looking at. And arguably it is a more accurate look at from an early stage company where you're doing something potentially very disruptive compared to incumbents in the marketplace. It's actually more meaningful for your vision and your story to look at building a total addressable market or a total available market from a bottoms up perspective. And that's just, for example, if we take, if we take a company and that's really looking at what's the number of businesses, or if your customers are businesses or people, the total number of customers in that space for a given use case, and then what's putting a value on that, and then building up those different channels within the total market and coming together and building that up from the bottom to come up with a larger number, and then getting a feel for what either a growth rate is on that, or what other segments of other markets you can start to pull in from. And that's where, thinking about, I have this example of Uber. There's a great piece, a few years old now, obviously, but great piece by Bill Gurley about assessing the Uber's total addressable market, and thinking about not the total addressable market shouldn't just reflect the market as it is today, but thinking about, given what our vision is, what's really the compelling value proposition of the company and what we're trying to build. What does the future look like? How does this fit into a world 1, 2, 3 years down the line? And how could this impact consumer spending or business spending? And so in that case, it's talking about framing Uber. Is it just the existing taxi ride market and that value? Or is it actually pulling in other consumers who previously weren't using taxis because of the business model, the prohibitive cost? So you start to look at, okay, we're pulling money away from people buying new cars because younger people, millennials, are foregoing cars in lieu of using Uber, for example. And so that's when we talk about fitting into the company's vision of the future. It's having a more flexible view of what the market could be. And that's part of the reason why we emphasize pulling away from pulling that Gartner report or the market research and looking up, this is a TAM, it's growing at 32% CAGR and it's a 6 billion. It's okay, let's unpack that a little bit. And so that's really why we look at bottoms up. And then circling back on part of the reason why investors are really looking for a larger TAM and ideally one that has a higher growth rate than others is because, going back to the KPIs of customer acquisition cost, when you're starting to get something off the ground and really looking at product market fit, you're thinking about what's really the potential of my ideal customer. And I think my ideal customer is maybe my top 1 out of 10, that top 90th percentile of customer. If I have a $1 billion market and I'm really looking at my ideal customer is that 1 out of 10, all of a sudden I'm really looking at a $100 million market that I can get, a serviceable kind of market. Versus if I'm at a 6 billion, then my 1 in 10 ideal customer, my top 90th percentile, is all of a sudden, obviously 600 million, 6 times larger. And so that's part of the reason why they're going to want to unpack that and look at the larger market is because they're going to be thinking about early on, how big is the pool of my ideal customers where my customer acquisition costs are going to be lowest, and then assuming, generally speaking, that it's going to be harder to acquire customers over time. And so that'll impact the interpretation or the assessment of what the growth potential is for the business, or how fast you can grow and how expensive it will be to grow in the short and mid run.
Well, and Chris, that's exactly it, right? The total addressable market is there so that an investor can see what's the opportunity look like, right?
Mm-hmm.
If the total addressable market is a $5 million opportunity, then why would we be writing a check for $500,000 into the company, right? So we want to see the biggest total addressable market possible. Now, there are niche markets that are not as big as, a more vague market, but as long as that TAM, that total addressable market, is a number that investors are comfortable with, it's a huge piece to be able to show where this company could go, how it's going to grow, what that looks like across the board. So for example, we'll look at, from our perspective, we want to see 10 times our money coming out of every investment. Now, we play the venture capital model, so we know 3 companies are going to go to zero, 3 companies are going to make our money back, and 3 companies are going to make all the money, and there's going to be one outlier. But for us to be able to see 10 times our money coming out of that, it's a function of looking at revenue and total addressable market. Because you're not going to be able to get to 10 times if the market won't even fit with inside of that. So that's really where you have to start looking at your total addressable market and really building your business around what does this market look like and how can you attack this market?
Mm-hmm.
Yeah, I love the Uber example. I mean, what's interesting about the Uber example to me is my sense is when they first started the business, they weren't thinking of some of the markets that they could get into, and probably would not have warranted valuations and investment to do that early on without kind of seeing that vision of where they could go. But they got the business off the ground. So to me, it's all about survival and matching your total addressable market with the amount of capital you're trying to gather. And I think what Saxon's point is exactly right. Is what you're trying to capture from a capital raise standpoint has got to match their expectations of growth, and the total addressable market defines that. And so that's just kind of why it's so fundamentally important to understand it. So, okay, well let's move on. Again, this could be another series on just this, and this is kind of the last area, but around a coherent go-to-market strategy. There's several components here, but I think this is an area that we see as we talk to businesses and entrepreneurs, and then subsequently investors, and the decks that we put together and help put together. This is an area that requires a decent amount of attention. I think needs to be flushed out for early stage companies a lot better than it is, and that's where Chris, again, from our perspective and our team, kind of knocks out of the park in helping companies think through this. A lot of this information kind of informs the model and how you're thinking about building the business. This is kind of an underrated area that you can slip up as you end up talking to investors. Like, who's your ideal customer? Are we enterprise? Are we SMB? Are we going to do it direct or not? Like, you really got to kind of understand your audience here and understand your business. Anything you want to add there, Chris?
In terms of go-to-market strategy from an investor perspective, and Saxon, definitely want to get your perspective on this, it's really looking at how am I going to reach my customer? What does distribution look like? What's my control over distribution? And how repeatable can I make this in terms of a process? And because repeatable and scalable is what's going to help you achieve that growth that hits the numbers that a venture investor is really going to look to hit. And so really not going to go into detail of each of these components in terms of what they are necessarily, because a lot of it is contextual to, like Will said, starting from who my ideal customer is, who has the pain points that are directly tied to what I'm bringing to the table from a value proposition, at least early on, and winning that first customer and getting a feel for who they are, and then working back from how do I engage them. The reason why we emphasize thinking through this earlier rather than later is because it's a core component to finding product market fit in terms of those early engagements. It's going to move a lot. It's probably going to change, but thinking through it helps you, informs a lot of different decisions you're going to have to make down the line. It could even, impact, potentially who your cloud partner is. If you're looking for, a cloud infrastructure, whether it's AWS or Microsoft, different cloud programs, for example, have partner programs, and so you might be able to pair your cloud infrastructure with a go-to-market strategy through a channel, indirect channel strategy, with being in a partner sales program with one of those bigger players. And so it's helping think through what's 2 or 3 steps down the line and how you might attack that, and then ultimately the ultimate test is it repeatable, is it scalable, and then does it drive the traction along the way? And so these are some of the components that go into that, all centered around the problem that you're solving and the ideal customer, and then how do you wrap a repeatable strategy around that?
Yeah, I think that's exactly right. Anything, Saxon, here?
I'd love to add something here. I mean, the biggest piece that you as an early stage company can think about, what makes the engine go, right? What's the gas? Excuse me. The gas is sales, right? Sales and revenue are what drive a business. So trying to figure out early on, what are your channels look like? Are you direct versus a channel? Are you selling to big enterprises or SMBs? These are key decisions that you have to make, because it totally changes the way that you're going to run this business. If you're selling to an enterprise compared to an SMB, the sales cycle for an enterprise company, let's just call it 6 to 12 months. Compared to an SMB, it might be 6 to 12 weeks. So these are whole different strategies, different personalities, different persona that you need inside of the business to really make sure that your plan matches up with where you want to get. And so that's a big, big piece of this, is really just understanding this. Now, you always can pivot, right? If you try initially to sell to the enterprise and it's just not working, you're getting some smaller SMB type leads and you're closing them quickly, then maybe it becomes a volume play. Instead of 10 customers on the enterprise side, you need 100 customers on the SMB side. But it's easier to get there for whatever reason, or vice versa. And all of this sort of leads into the marketing plan, right? How do you attack these individuals? How do you get to the buyer? How do you get the buyer in the room? How do you get the buyer to make a decision, right? So the marketing plan, which at the top of the marketing plan should be lead generation. How are you going to feed the funnel? How are you going to get your leads, right? So looking at how you're getting your leads, what your marketing is looking like, and then ultimately how you're selling this product. It's all a puzzle, and there could be different pieces that fit in different ways. And you'll realize after testing and trying a few different things, this is going to work or this isn't going to work. For example, my previous company, WeView, we sold to what we thought were going to be large size tech companies. We thought we had a corporate culture product for photo and video engagement. We thought that we were going to go out and we were going to sell to the Microsofts, the Apples, the Amazons of the world, because they have great corporate culture. Well, what we realized was our product wasn't encrypted enough to be introduced to these types of companies because we didn't have the security measures put in place. So where did we land? We landed on the SMB space. We landed on the Tribridges of the world. We landed on the Vector Learnings of the world, the Volugies of the world. That's where we landed, and that's where we had success. It was after we tried so much on the enterprise, and then we flipped a few switches, and we're like, oh, wow, this fits much better in the SMB market. So these are things that you're going to need to think about. And really, I can't stress enough, a lot of what we've gone over today, total addressable market is something that's huge, but really sales are what fuel a company. And so really stepping back and understanding from a sales perspective where your company fits, how you're going to sell, and who's going to be that individual that leads that. And maybe it's you. Maybe you're a technical founder and you need a CEO that can sell. You just got to understand and really make sure that you have the right personnel in place to accomplish what you're trying to accomplish.
Always kind of feeds back to the model, feeds back to the financials, all that kind of good stuff, which is why, even though we're kind of purely thinking about this from a financial perspective and kind of our invite that we put together here, these all kind of tie out, to Saxon's point, back to money coming in the door and your plan for money to come in the door. So,
and to add to that, to Saxon's point, there are each different flavor has different implications, and what we seek to do is then tie that back to the unit economics in terms of what's the different profile look like for my unit economics on the CAC and LTV side if I take an enterprise route over that 6 to 12 month sales cycle and bring on field sales team and things like that is translating that back into the metrics that are going to be used by investors to take a real deep look at the company and showing what those differentials are across those metrics that we believe are important to our business.
No.
So we have a question here, guys. I just want to ask it. We have about 12 minutes left. What if we've been operating for a while with great traction, but almost no conversions and no revenue? What if we are looking for funding to make conversations possible in the first place and have no profits to show? What do you guys think?
Interesting. So defined as traction, I guess I would question what we're defining as traction here. So does the question say we have traction or we don't have traction?
We have great traction.
Quite great traction. And so company has great traction, but no conversions and no revenue. So maybe traction in this situation is good leads. Maybe it's good partnerships, right? Let me take a stab at this, guys. The way that I would answer this question is show whatever traction you have and tell that story, right? There are companies that are never profitable, but the reason that they're successful is because of the traction that they have, right? They're not needing to be profitable. They're growing as a venture or private equity backed company. It's not profitability is what they're looking for. They're looking for growth. So maybe you could show growth rather than traction, rather than profit or revenue.
Yeah, you're talking to an accountant now, so the accountant will kind of come in and say, "Well, let's look at the path. Is there a path to revenue? What's the plan to revenue? We got to build, turn traction into revenue because ultimately, if we're trying to attract investors, we've got to have enterprise value. Enterprise value could be just users, but I think eventually, even for Google, it has to turn into revenue, or even for Amazon, it's got to turn into revenue or profitability, one or the other. There's not a long-term traction play that doesn't include revenue or profits, in my opinion. I could be wrong, but I think I would try to sit down with these individuals or the leaders of this company and try to figure out how do we convert this into revenue is what I would be looking at.
To add to that, I think it's also would be wanting to sit down with It's great traction. That sounds like probably stronger relationships or building relationships in the market. And hopefully that also potentially means either, I guess it sounds like conversions here is no revenue, so maybe no monetization, but doesn't mean maybe users or partners in the platform or using some degree of the features. And so leveraging those relationships and that traction that you have to, in addition to Saxon's point, telling that story around what you have in traction, is then leveraging those relationships to dig into and take a step back and dig into where do they see the value? What is the value that has driven that traction? And then how do I dig deeper into that value to then work toward converting that into some degree of monetization? And then being able to having those conversations and charting that path of the value hypothesis and refining that based on those relationships that you've been able to get, then that will help augment the story that you can tell with investors to get you over the goal line to monetize that traction that you've been able to garner.
So we have about 10 minutes left. I want to make sure that everybody can ask the questions that they would like to ask. So once again, you can use the chat function or the Q&A function. We're monitoring both here. But if anybody does have any questions, would love to make sure that Chris and Will can answer them. And just so everybody knows, we'll have contact information after the fact. Chris and Will are open and would love to have conversations with everybody here, especially around this type of stuff. So we'll have that contact information as well at the end.
Absolutely. We'll put. I think we only have like one slide here left, Saxon. So we could quickly just put this up here. Pretty self-explanatory. Investors are looking for a great management team. It's going to start with a leader. It's going to start with an angle or knowledge that you have in a space that you can create value. And so you're going to need to obviously execute, and you're going to need financial leadership. And I think we've kind of talked about the need for all those roles at specific times. That you don't need all these things on day one, although you do need a founder typically on day one, and probably some type of angle as to what you're doing. But the rest can be pieced together over time as you build out the business. Anything you want to add there, Chris or Saxon? I don't want to kind of run over. I do want to leave enough time for everyone.
I mean, it's all about team. I mean, you guys see this every day. We all know this with an early stage company. Our famous line is you're betting on the jockey, not the horse. We're betting on people that we know are going to be in the trenches. They're going to be able to pivot. They're going to be able to fight every day to make this company successful. We're not always looking for the Mark Zuckerberg out of his garage. We're looking for maybe an entrepreneur that's been there and been successful before, and they're on their second go around. Or another thing we love to see is an individual that had a high paying job. They leave that job to be able to solve a problem in that industry. We have a company like that here at Florida Funders, a company called Rep Scrubs. It's the CEO is an individual who was very high up at Stryker, making a very nice 6-figure salary. And he left that job to be able to solve a problem inside of that industry. And so we love to see that. And then the other thing you really got to pay attention to is how well can that leader recruit, right? Startups don't have as much money as Apple and Google and Amazon. They can't go and hire everybody they want to. But what they can do is the founder can be passionate. The founder can convince others to join them on the journey that they're on because they're going to be successful. And do they know that at that point? Maybe, maybe not. But it's all about that passion and making sure that that's very, very visible from day one.
100% right there. I think it's interesting to find founders that come from the industry that want to solve a problem. I think that is a huge kind of piece of it. Although Chris and I have seen founders come from all different shapes and sizes with different ideas from different areas, but certainly makes sense. Any other questions popping up at this point, Saxon, or we've got our contact information. I think that's covering everything we wanted to cover. I know we're about 5 minutes from being over in time.
We don't have anything else here today. I wanted to, oh, we do have something here. This is just a note. There's a book called The Mom Test. It is an excellent way to understand traction versus real biz. That's a good question. I have a question for you guys. Resources. Any good resources that you'd like to share with the group here today?
I could start here. I mean, I listen to pretty much 2 to 3 podcasts a day, whether it's during workouts or whether it's, driving my son to baseball practice. But there's a ton of great podcasts out there. One that I listen to is How I Built This. Just gives you a lot of great kind of dynamic stories of different shapes and sizes of companies and what they had to go through to get to where they went, all the challenges along the way, and then also diving into like how they solved the problem and how they kind of did things. And so that's one I listen to. I know Chris has some others, and he's much more of a voracious reader than I am, but he probably has some good ideas.
Yeah, I mean, there are a lot. I think the beauty of the time we live in today, and I'm not highlighting anything new, is just the vast amount of resources that are out there. Just the democratization of information. I mean, there are a lot of people, resources on Medium. I would say, one area, I think, because there is so much information out there, I would say it's harder actually to find the most useful and applicable for your business is to try and find venture partners, whether it's via Twitter or LinkedIn, and find their presence. A lot of them are active. A fair number of them are active on Medium, which is a big kind of newsletter blog resource, as well as a lot of them also have newsletters. There are others that have maintained websites in different venture groups, whether it's Sequoia or Matrix or Kleiner, have a lot of resources on their websites. I think those are great for digging into topics. From a podcast perspective, I think the venture firms, whether it's Greylock or others, have different podcasts I think are also helpful that I listen to. The other one that's good in terms of a broad array of things is Invest Like the Best, Patrick O'Shaughnessy. From a newsletter perspective, Stratechery with Ben Thompson. There's a free version. There's also paid content there. So I would say, just if you have specific questions about content about a specific topic, shoot me an email and I'll put together a list. But that's kind of a broad brush view. I mean, there's a lot of great stuff out there. So I'd be happy to help kind of parse through the noise for anybody. Just shoot me an email.
Yeah, a few things on my side. Podcast-wise, Florida Funders does a great podcast that Tom Wallace, our managing partner, he hosts with very well-known investors. We've had Alexis Ohanian on there, had Jason Calacanis on there. We've Adam Struck, who's going to be on there this week. So I would tell you to check out that. Steve McDonald as well has been on there. Really, really great podcast. I like seedinvest.com and go to their academy. There's a great list of infographics and really interactive content that runs through both the entrepreneur side and the investor side, understanding everything from terms all the way down to things like TAM and customer acquisition costs, some of the stuff that we talked about today. And then use these guys. Use Will and Chris. I mean, these guys know what they're doing. I can attest to that. I've worked with them for years, and they're really great to work with. So I would encourage everybody to reach out to them if they have any questions. We are out of time today. Chris and Will, I wanted to thank you guys so much. You did an amazing job as always. Everybody, have a great holiday. Be happy, be safe, be healthy. We will follow up with a recording of this, and then we're also going to turn it into a blog post. So we will speak with everybody soon. Have a great day. Thanks a bunch. Bye.
Thanks, everybody.
Hi, guys. It was our pleasure.